Well, thank you guys for coming. I'll get started. I know there's a few people still outside, but we'll get them ready to go here. Is that too loud? No? Okay. I'll have to talk soft. So obviously today we're going to talk about the elections. As everybody knows, I try to kind of combine the approach to these events between deep dives and other experts. I know I've told this story before, but somebody a while, maybe last presentation, I had two guest speakers, and they said that, boy, those last two speakers you had were amazing, and I was the one before them, so I wondered why they didn't say the three of them. And I think those of you who saw last time, Weston is phenomenal, and so he set the bar high. So I'm going to lower the expectations today for sure. But the elections, frankly, it's not my favorite presentation to do, partly because there's only one new president each time I do this, right? Every 4 years we've got just one little set of data, so the data is a bit redundant. But I wanted to just spend a quick minute talking about the approach. First and foremost, we do these events because it's really cool to be around everybody. It's one of the, people come up to me and say, wow, this, you've gotten a lot bigger and there's so many more people. And, frankly, when you start in the business, the goal is just to pay the bills. And when you get to this point, it is really cool that we have meetings where we might not talk all that much about people's finances because we've been doing it for so long, and it really does become a connection and a relationship thing. And so that's definitely one of the reasons we do this. The other reason is just because of our commitment to education. We've always felt like that's a big deal. First, I don't know if everybody knows Robert's nickname is Cobb, but just in case you don't know, Cobb and I have, been doing this, education thing for a long time for several companies. We've just kind of always figured that the best way to attract folks to us and to keep folks with us was to provide education. So we've always felt like that is a really big part of what we do. That kind of takes me into the purpose of the education, which I always feel like I just want to disclose, I guess, that our purpose is not to wow you with crazy information. You have plenty of places to go for that, right? Most of the media outlets are trying to make you really emotional and trying to do all that. That's not what we're trying to do in here. We're trying to steady and provide, a place where you can go to quiet the noise. The fourth quarter food for thought is going to be the playing of the movie that I had mentioned we were going to get a screening of, which is a documentary on the academics from the University of Chicago. And it's called Quieting the Noise. So it's just something we take a lot of pride in trying to do in these meetings. That being said, it does feel a little weird sometimes when I know you've heard certain things, and I use myself as maybe that you've heard these things over and over. So I use myself as an example. Amongst others, a place that I'm very interested in learning and growing is entrepreneurship. So I probably listen to 2 or 3 entrepreneurship books a month, and those are, I'm not listening to those because I think I'm going to hear something I've never heard before, right? The vast majority of the time, it's something said a little bit different, a new spin, and I just find that if I read something and I hear it, 3 years later, I'm not using it anymore. So I have to keep it in front of me all the time to kind of get that practice. And that's the same viewpoint that I take here. And so, for those of you who were here with us 4 years ago, you're going to see some of that same data. But I guess I asked for permission to be able to provide that and for you guys to, I'll try to do it in a little different way. So, elections, right? Obviously, it's an emotional time. It's a tumultuous time. It's a pretty neat time when you back up and realize that we have the opportunity to vote for people that we think share our values and support our views. Maybe those people aren't on the ballot now. Maybe they are for you. I don't know. By the way, I appreciate a couple of you who decided to wear election-appropriate gear today. That's very nice of you. And maybe black, for those of you who are wearing black, that's also election-appropriate gear today. So there's 24 presidential elections that we have reliable data in U.S. stock markets going back to 1926. So there's 24 elections that fit into that, starting with 1928. Does anybody remember who they voted for in 1928? Just messing with you. I was going to pick on one of you, but I decided I decided I would go to everybody on that one. So 24 elections. Anybody have any idea? How many of them do you think were negative years or positive years? How many years in, somebody said negative what? Negative in the market. How many of those 24 elections do you think were negative? Mr. Foster got it on the nose. So 4 years, 4 of the 24 election years had negative returns in the market. For now, when we talk about the market, we're talking about the S&P 500, okay? With an average return of 11.6. That's not an annualized compounded return, that's an average return. The highest returning year being in 1928, just before the collapse, and the lowest return in 2008. Okay, so from a market perspective, one of the things that's a kind of prevailing theme that we'll always talk about is that, people have cash and they're waiting to decide when to put it into the market. The answer for us is it's always the right answer to put it in right now. The reason is statistical, because the market is up 75% of the time roughly. So from a statistical perspective, every day that you wait, you're missing one of the opportunities to have 0.75% of the time to have a positive return. So just a little bit below that, right? And I'm not exactly sure why that exists. I don't know that there's a pattern to take away here. I've heard some people talk about, generally elections have carried some optimism. And so, maybe there's kind of an optimist sentiment in the market. So then if we start to look at who's been in office through those periods, you can see that there's no real distinct pattern that jumps out. Again, this is part of my intro is, you're not going to see a whole lot of places that I stand up here and say, here's exactly what this means. So if Republican wins, you should feel like this, and if a Democrat wins, you should feel like this, right? There's not a whole lot. You could maybe make the assumption that initially that more years have been negative under Democratic, president than Republican on this first slide. But it just gives you an indication that, election years, if we look at this, the average return of the non-election years is 12.4%. So very close. The compounded return in the S&P going back to 1926 is 10.3% on an annualized basis. So both the average returns, are very much in line with what we expect for long-term market averages. So again, you don't see a whole lot there. Now, if we look here, this is, I think, an interesting component, which is, when somebody gets elected, how much should they be responsible for the year they get elected in? Or how much do they, when does it take time for their policies to manifest, right? You can hear it in athletics where a coach takes over and they say that, Deion's still playing with, the previous coach's players, right? And so what we looked at here was in the year following presidential elections, does that change, right? Is there something inside of a certain political viewpoint that gives us some insight there? And what you see is a little bit different story, still kind of within that 75% kind of range, but you see more negative years. Again, without anything concrete, maybe this is where the optimism wears off and we realize that they all make promises that they don't keep, and so there's a change in our viewpoint. I don't know. But you can see that the average return is still well in line, right? We talk about tens being an important number because of market returns, and you can see we're back in that range. A little different conclusion potentially if you start looking at the administration component of it, because now we see that Republicans end up with a little bit more weight on the negative years. So, again, not a huge conclusion. So for those of you who have real concerns about, who would get elected, there isn't anything in the data that shows that either in the year they're elected or the year after they're elected, there's some pattern that we can see. I think it's important because at the end of the day, when you talk about who you vote for and what policies they follow, you probably expect that these intuitions you have about policy, right? Which I'll talk more about this later, but maybe the intuition of if you vote on the right, you feel like reducing taxes creates economic growth. If you vote on the left, you generally might feel that the rich don't pay enough and that we should solve that problem by taking more money away from the higher end earners, right? And so the question is, you might think that for a lot of different reasons, right? There may be social reasons for that. There may be values reasons for that. Maybe one of the reasons you think that policy is the right policy is because your expectation of how it manifests economically or from a market perspective, right? You think those things are going to enhance the market experience, okay? And so the question then becomes, does lowering taxes or does taxing the wealthy more, does it actually manifest? And I'll speak on this multiple times, but I'm not here to tell you if it manifests in all those other areas that you're concerned about. I'm really not even here to tell you if it manifests economically, because I'm not an economist. I'm here to tell you if there's patterns from a market perspective. So when we think about some of those areas, let's just kind of go through, some of those paradigms that we might have. There's two different presidents we're talking about here, but different situations that we might look at. In this scenario here, on the left-hand side, we're talking about unemployment at 7.8. We're talking about annual inflation pretty close to target, a budget deficit of, and this is aggregate over the term of these two presidents, right? -15. 2%, a little above 2% in GDP. Over here we have 10% unemployment, lower inflation, much larger budget deficit, and lower GDP growth. I would say already the data doesn't necessarily make sense, because kind of functionally you would think lower unemployment, more on target for inflation, lower deficit, better GDP growth. How does that end up leading to a market return that's so much worse? I don't know the answer, but I do know that it challenges the paradigm that these policies are automatically going to manifest themselves into the market. Anybody have a guess which president? The left is a little easier, so who was president on the right? So that's Obama and Bush. Okay. So, I say the left is a little bit easier because it's negative, and there's not been a whole lot of presidents who through their entire term have had a negative return in the market, right? So a couple interesting things, go ahead.
Doesn't that have a lot to do with when 9/11 happened?
You exactly like I paid you to do. That was perfect. She asked if that has to do with 9/11, and you start to look here, right? And again, this is the angle of this presentation is from a political perspective. George W. had a negative return, but again, think about what caused a negative return when George W. was in office. First of all, he took over during the tech bust. I'm not sure you could pin the tech bust on him. Certainly, you can't pin 9/11 on him. Probably most of us feel like that was a pretty amazing kind of galvanizing of the country. Nobody wants terrorism, but at least we felt like we were together then, in a lot of ways. And then 2008, I'm not sure you can really pin 2008. You could probably pin 2008 on a lot of presidents who, similar to the interest rate environment, who compounded a problem year over year. Maybe the same thing could be said for Obama. Took over right at the, bottom in monetary policy. You guys can remember the pictures of Bernanke printing money, and, that generated a major boom in the economy, right? I think interesting, the best return didn't even get elected, right? So maybe it's more a commentary on how we vote than it is who's really in office, right? So, I think it's important to realize when you look at this, okay, all sorts of different economic policy that spans those lines of what I mentioned, right? All sorts of different world events that come up. And so why do we generally see, why do we believe we see this trend where it's up the vast majority of the time? And I would say it even happened here. We just had 3 instances. Because we always believe, and we want you to always believe, that businesses will figure it out. And so even if you take what happened with Bush, I would argue businesses figured out the tech thing, and we're starting to figure it out, and then got hit with 9/11, which caused its own havoc, and then they figured that out, and then they got 2008, and then had to figure it out all over again. But we saw it, I think most recently in 2022, I've talked about this before, but we saw Cost of capital go up, compress profit margins for businesses because expenses are rising, because interest rates are rising, inventory is shrinking. So all those things cause pressures. And we saw businesses lay off workers. We saw shift to innovation and more AI, right? We see these things. So ultimately, it's kind of like as a retiree, you either have enough money or you don't. And if you don't have enough money, you either have to work longer, spend less, or die sooner. Right? If you're a business, it's similar, right? If you don't have profits, you either have to find a way to generate more revenue or you've got to cut costs, right? And so we have seen that happen really regardless of who's in office. I'll take one more question just because I want to honor the time.
Were those numbers inflation adjusted?
No.
Should that be a factor?
No.
Next question.
Because it's constant. Because it's constant on all of them. And I'll talk more about inflation. That the president doesn't necessarily control that either. So this graph, what we're talking about on the bottom is who's in office, right? That's who's in office over those years, going back to 1969. And the thought process here is what happens if you invest $1. This is investing $1 in just the years where Republicans were in office. Okay? So $1 grew to $19. This is the money in just when Democrats are in office. So it grows to 127. And then this is if you stayed invested through all of it. Right? So there's, if you want to take the position that the Democratic years grew more than the Republican years, you could dive deeper into data. You can kind of see they mirror each other for a little while, and the real expansion comes in 2008. But the message here isn't necessarily about whether Republican or Democrat is better. It's that when you try to time them, you lose, right? And every once in a while, I'll talk to clients and talk about, that periodically we'll tell somebody they might not be a good fit for us anymore. And the majority of the time, it's because people want to time markets. And there's plenty of advisors out there who will time markets, so you can find those people. But we've had a few who have repeatedly asked us to do that, and a few that we've honored that request, and they've always lost. I mean, it's just, it never has it worked. They've always ended up with much less money. So what that ultimately gets down to, one more question? Go ahead.
Yeah, back to the previous one where the all years is much higher than either one individually.
Yeah.
It seems a little statistically awkward. Can you describe why that's, you're doing something with the compounding, you're missing the compounding or something?
No, it's just because if you're in just, I'll go this side. If you're in just these years, then you're out during that year. You're back in during that year, you're out during that segment, you're in. So the reason it's so high is because you aren't missing the returns when you decided to time the market and get out of the market. Okay? So the message here, really is we've seen it through, regardless of administration. For those of you who were at the last election, this was kind of the series that I had talked about before. We've seen it through all different administrations, and it really doesn't matter. Long-term investors are rewarded for staying in the market. I want to make sure that that doesn't mean do nothing. That's always really important for me to say. You guys know that if you watch your accounts, there's activity. There might be activity periodically on quarterly. There might be activity in the tolerance bands, which you guys might remember, where we make decisions based on how high or low a particular investment moves. So it's not to do nothing. There are shifts that should be made. There's plenty of data to indicate how we participate in the markets and get the most out of them, but it isn't to try to figure out if one of the administrations has some policy thought process that's going to help you or give you some indication of how to be a better investor. So that leads to the next potentially logical question, which is, what about full control? Okay, so what this is when parties have total control, what is the return in the market? Okay, and so what you look at, this might be the one place that gives you some insight. Okay, and I would say that, so what you know, as you'd expect, the blue lines are Democrats, the red lines are Republicans. The white is when it's mixed. So I think the one intuition we have going into this is potentially validated in the fact that nobody likes in business to have some potential for massive swings and changes in what they're doing. And when one party has control, there's a greater vulnerability that there's going to be a big change in some policy. When there's a mix, you know, you potentially think, like, for example, we've heard things floated around, which it's hard to believe it could happen, but that they would tax unrealized capital gains, right? That scares me. I'm sure it scares all of you. I'm less worried about that if Congress is mixed, because I don't think it can go through, right? And so those may be places where you kind of have some viewpoint in here that is validated a little bit. We will say vote with your ballot, not with your investments. Maybe that's a place you could do both. I don't know. I don't know that the data is strong enough. I'm just saying when we look for correlations in the data, that's one place that we see some that might be interesting. So let's shift gears a little bit to tax policy. When we think about kind of the various places where we are kind of interested in whether somebody supports our thought process or not, and how that might manifest in economic data and in market data, of course, tax policy is a big part of that. And so, you know, as a kind of a recap, you know, when we think about general tax policy, right, we think about the right, emphasizing tax cuts to promote economic growth. We think about the left, focus on raising taxes on the wealthy, right? When that comes down to corporate tax rates, what that's meant is Trump dropped them to 21%. Harris is looking to increase them back to 28%. Again, just under the idea that corporations, you know, need to pay more. And it's just a philosophical difference. You get to the income tax rates. Obviously, this is a big one because we know next year's the last year of the Trump tax rules if he doesn't get reelected and find a way to keep them in. So top tax rates were reduced to 37%. There was lots of other things like standard deductions were changed, but effectively, you know, you're generally taking a 3% haircut when those rules sunset. And then Harris is proposing to raise those back to 39.6. And then there's a number of other things, you know, potentially like the wealth tax and some of those other things that are targeted more at, you know, high to ultra high income earners. They should also take into consideration how much sports your kids play, because that determines how much wealth you really have, what sports you play. Capital gains tax. So now we're talking about, you know, Trump staying at 20, and this is where there's, you know, maybe more ambiguity, but Harris proposing maybe something a little bit like California where it's more tied to your income. Okay, so just, you know, I'm not here today to tell you if it's right or wrong. I'm here to tell you those are different philosophies. And generally, when people attach themselves to those philosophies, amongst other benefits, they would think they're going to benefit them somewhere financially. So what we looked at here was different presidents, different income tax rates, different corporate tax rates, different capital gains rates, and corresponding returns in the S&P 500. Not surprisingly, if we go through this, you'll see from an income tax perspective, hard to believe it was 91%, but you could write off everything. So that's why. And that was, you also had to be a really, really high earner at that point to be in that tax bracket. So, but really high taxes historically, right? Some of you may have seen like the historical tax rate chart that kind of runs through top marginal tax rates. That was a period where taxes were historically high. You can see just right underneath each other, one year where the market's up 19% and the next year where the market's flat, well below and well above long-term market returns, despite the fact that income tax rates had stayed the same. If you come down on the bottom side, you can see Bush tax rate, you know, 28%, that market's down 3.1%. Obama also low historically at 35%, the market's up 12.8%. Okay, so, you know, again, this is where I kind of feel like I don't mean this presentation to be rhetorical. I apologize that it probably feels like that. I know nobody expected to come in here and have me tell you the sky is falling, but you see the same thing in corporate tax rates, right? We see high corporate tax rates. We see that same trend that we saw before, where we have, a market return that's, 9% above long-term market averages and one that's 10% below market averages on the top. You also see coming to the bottom, Clinton and Trump, Biden. Really, you could say Trump, Biden, kind of together in this one because it stayed the same, which is funny. So, and then we see, negative 9% and positive 16% in terms of market returns. And then moving on to capital gains, there's a little less deviation in return, but you can see the highest when Bush was in office, negative return, the lowest when Clinton was in office, negative return, but same rate. And we see 12.8 and 16.3 with Obama, Trump, and Biden. Okay, so go ahead.
So if it's not the income tax rate that affects it, it's not the corporate tax rate that affects it, it's not the capital gains tax rate that affects it, are you saying it's just consumer sentiment?
I'm not smart enough to answer that question, probably, but I think it's everything, right? The message here, and this is also a great segue, is we believe that prices are accurate. Okay, it's called efficient markets, right? If anybody's a gambler, you know that when they set the line, they set it in a place where they think there's going to be an equal number of buyers and sellers. And if you ever watch it, which I don't gamble on sports much. My kids' soccer games excluded. They're pretty dang good, right? I mean, you don't find mispricing there very often. Well, we believe the same thing exists with stocks. You've got, billions of dollars being traded every single day by really informed people, right? I like to say that this notion that I get emails all day long of, we got this, new fund manager and she's from MIT and he's from Harvard. And it's like, if you really think intelligence is a differentiator in this industry, you're crazy, because the best investors were from the best schools and so were the worst investors, right? So all those people are poring over that data, right? And so whatever the price is of a security, I think back to 2008 when people would say, we had a banking arm to our business, and people would say, well, my house, right now it would be 600,000, but it's really worth 800,000. And it's like, no, it's not. It might have been worth 800,000, but right now it's worth 600,000. So it's not to say that the election isn't one of the data points and who's in office isn't one data point that's incorporated in all the data that's part of the pricing of securities. We believe all that data is being considered. And so it's reflected somewhere. The key question is, does it give me an opportunity to have a better investment experience? Is it correlative or is it causative would be another way to look at it. And I think the data, from that perspective is clear. So let's move into volatility. Volatility is measured by something called the VIX, which I'm not going to get into, but it has to do with options in the S&P 500. But effectively what this shows is just kind of from a relative perspective is the level of volatility that we're seeing in the markets. The circles on the bottom are election years. Okay, there may be some trend that you could see that there is kind of some volatility heading into election years, although this thing is all over the place. Right? I heard a professor describe this and say, you could think of this a little bit like waves, right? They come crashing in and then they come soft and then they come crashing in. And if you've been in a riptide, anybody know the thing you don't want to do when you get into a riptide? You don't want to fight it, right? You want to let it take you, right? It's a pretty decent metaphor because this volatility is going to come and go. You could take years like 2004 and say, clearly not a whole lot of volatility going into election. You could contrast that with 2020, 2008 and say tons of volatility going into the election, okay? So a different way to look at it would be the average close of volatility over those time frames. And the thing, even if you go back to this, right, those periods of high volatility, 2008, was it the election that caused the high volatility? Maybe. I would argue that it was the fact that banks were failing and it was a thinking back to that was, crazy. 2020 being a pandemic was crazy, but having been in the industry in 2008, you know how it is, like it's recency bias, right? You always think more about the things that are in front of you than the past, right? It's why the good old days were good, but not for everybody. If you think about the good old days, there were some people who weren't so good. Their life wasn't so good in the good old days. But 2008 and 2020, we're talking, the biggest financial crisis since the Depression and the pandemic. So if we look at those years from a volatility perspective, the question becomes like, is there action we should take in volatility? We see it right now, right? There has been a lot of volatility. I'll talk a little bit more about it, but the tail end of that graph, we have seen quite a bit of volatility, although it hasn't been negative volatility because the markets have still done well. We have seen a fair amount of volatility, especially in August. We actually had the largest increase in the VIX in one day that we've ever seen. These are the year ends. So let's just take a look at trends. The average VIX 19.1 in 2020, the volatility was extremely high. The market was up 18%. In 2022, the volatility was extremely high. The market was down 18%. In 2008, super high volatility, down 37%. 2009, also high volatility, up 26%. So we see in periods of high volatility, can you use volatility as a measure of what to do? Unfortunately, you can't, because we see volatility be the catalyst or be a precursor to really great growth. And maybe catalyst is really the wrong word, so I shouldn't have used that, but associated with high growth and low growth. And we see the same thing on the other end. Low volatility historically in 2019, markets up 32, low volatility in 2005, markets under long-term market averages. So volatility doesn't become a catalyst for that. One thing that I think is interesting, if you look at the dispersion of returns, this gets to the fact that the market is up more than it's down. What you see at the tails, right, is when returns on a daily basis have a more material move than 2%. So inside this little shaded area means that you're moving 2% positive or negative. Okay, on a daily basis. Percentage is important because numbers lose their kind of value as we get bigger numbers in the indexes. It's kind of like dollars, right? I tell people all the time, when you come into my office and you say I'm down $50,000 or I'm up $50,000, I should have used up, not down. Never come to my office down, they're never down. If you're up $50,000 or down $50,000, how do we get there, right? Well, if you have $500,000, let's use 100,000 because it's easier math. I'm down or I'm up $100,000. If you have $1 million saved, percentage-wise, you're down 10%, right? If you didn't want to be down as many dollars, you should have just only saved $50,000, and then you would have only been down $5,000, right? And so, you think about as you guys have gained more wealth, and, many of you in this room have multiple millions of dollars. Yeah, the percentage, you look and you go, that's more money than I ever made in a year, maybe 2 or 3 years that I just went down in one day. That's just because the law of large numbers, right? It's similarly in the market. You want to think of percentages because, where the Dow was from a dollar or from a points perspective is not relevant 5 years and 10 years away, right? So it does tell you that a massive amount is within a relatively low period of volatility. You can see in there inside that distribution. So let's go back to 2024. As I said, we had the highest change in VIX. This was August 5th, I believe. But you guys probably remember, huge volatility enters the market. Within a week, you lost 10% if you got out of the market. So if you used volatility as a measure of risk to get out of the market, $1 million, you lost $100,000 by getting out because you saw the volatility get really high. Which, of course, keep in mind through all this, the media loves that stuff, right? I was just on the news this morning, and every time I get on the news, when I talk to my media coach, I want to blow the news up so bad, and I can't because I'm on it, right? So I always have to stay away from it's the media's fault because I'm sitting there talking to the people that are on the media. But that's such a big kind of function of this that we have to, again, quiet noise around. So I think this is pretty interesting. You've seen versions of this if you've been with us for a long period of time. But what this shows is if you had your money invested, oh, sorry, I didn't this is the Russell 3000 from 1997 to the end of last year. If you had your money invested, you were up 9.8%. A dollar became $10.55. If you missed the best week, you went from 9.8 down to 9%. You lost 80 basis points in return by missing 1 week in the market. If you missed the best month, you were down to 8.8%. If you missed 3 months, 8.3%. And the best 6 months, you were down to 7.9%. So a dollar grew to 6.7 instead of 10.5. Okay. What I think is interesting, I mean, it probably doesn't surprise you. And one of the things we try to talk with you all the time about is, and this is primarily for expectations, is just we believe that a good advice, and it comes from the value of the advisor study, is doing a bunch of things really well over and over and over and trying to catch little bits of margin here or there. We think that's a noble cause because little bits of margin add up to enough, especially on the size accounts that you all have in this room, where over 20 years, 0.51, 1.52 over your peers is a big number to the bottom line, right? So you guys probably have some intuition around that, but look at this. The best week was November 2008. That would be a really easy time to get out of the market. Right? I mean, that was right. I think the worst day in 2008 was October 5th. That was the bottom. Right? You go back to the best months, also really easy to get out of the market with everything that was going on. Right? So as you can expect, it's easy to think, especially with hindsight, and 2008 was a really good example of that, particularly being in the industry where people, like with hindsight, would say, we knew that, they knew this was going to happen, right? They knew this was going to happen. We heard that a lot in 2008. Some people maybe knew it was going to happen, but the majority of people didn't because it's really hard to figure that kind of stuff out. So we also vote, I think, to some degree for national debt, right? We think that there's a different philosophy. There's an unfortunate reality. It starts at 266 billion, it's up to 33 trillion, and unless I missed a number, there is no time where it dropped. 35 today. Yeah. Right? This is by the end of 2023. So I'm not sure any administration has had the political will to tackle this. Now, there is economic, if you guys listened, and I'm not going to get deep into this, but I just want to float this for a second. When we had the economist from State Street speak, when your debt is attractive, you don't necessarily have to have a balanced budget. That's a big risk for us, but it also is a place where you can avoid some anxiety of how does this work, right? He talked a little bit about a long-term concern, and I'm paraphrasing, is BRICS and other currencies being established, which would make U.S. debt potentially less attractive. That being said, if you look at this axis here, what we're seeing here is we're talking about market returns on that side, and then we're talking about GDP on that side. The red line represents our expectation. I think generally the expectation would be that as GDP, debt to GDP increases, we would see a decrease in returns in the market. Is that fair? So that's the cluster of returns at different debt levels. Okay. First of all, you can kind of see that the first thing that jumps out to me is there is a cluster, but the cluster is proportionally above the line. So it kind of confirms the 75% of the time the markets are up. Also, that kind of line that I drew, 100, 150% of GDP, you don't see that there's a shift where you might think returns are going to go negative at that point. You don't see it. Matter of fact, it still looks like the percentage kind of exists. If you look at this is the US returns, and you can see, again, vastly above the line. One thing that I think is interesting, that circle right there is 2022, that circle right there is 2023. With no change in the debt level. Again, just kind of to dovetail off Ava's point, I'm not saying that debt levels aren't incorporated into the price of securities, but they don't give you an indication of, hey, when we reach a certain point, we need to make a decision because at that point the markets need some, reversal to be able to take care of that. I mean, it would seem that whether we inflate it out, generate more revenue, or which would be taxes, or cut spending, something has to be done. But I don't know that we can correlate that to the market. So let's talk about the Fed. The reason that I'm talking about this may be a little bit less market driven, or election driven, but I mean, we just came off a 0.5% drop in interest rates, and so everybody in the room has to be on some level in tune with that, and so this is just top of mind. This was what I was on talking about this morning, but what we can see here is federal funds rate. There's an interesting concept. There's an economist named Brian Westbury who has dug into this. Some of you may read him, but from what I understand, the interest rate movement used to be driven by available capital from the Fed. Okay, they didn't actually move interest rates. They constricted availability, which controlled supply and demand from banks, because the federal funds rate is the rate which banks borrow money from the government. They do that mostly when they need more reserves. So that was a big deal in, I think, 2008, where they said, we need more reserves to ensure we're not going to have bank failures. Banks have to go borrow that money from the Fed. And that supply and demand drove the change in interest rates. And in 2008, that got decoupled quite a bit, where now it's more of a Fed decision as opposed to a supply and demand issue. But what you can see is it doesn't really matter in terms of the Fed funds rate. You have Democrat, Republican, Democrat, and the Fed funds rate stayed exactly the same. It kind of speaks to, the inflation. I'm not sure inflation is a Biden issue. It was, president after president after president who left interest rates, or I should say Fed chair after Fed chair after Fed chair, that left interest rates extremely low. So what you're looking at here, and this speaks to kind of what do we expect from the change in rates that we've had right now. Like what indications do we have? What do we know about the Fed and what their action is? I think what we do know is that the trend of monetary policy has shifted, right? We were in a trend of inflation is the big concern, aggressive monetary policy to stem inflation. For those of you who don't know, the Fed has generally two mandates: inflation and employment, or unemployment, right? So it's to deal with those two things. Now, raising rates was to bring inflation down. Recent numbers close to 2.5% indicate inflation may be under control. Also, recent weakening in the labor markets draw some concerns about recessions, right? Because now we have to wonder, did the Fed wait too long? That's the question everybody wants to know. Did the Fed wait too long to drop interest rates, and do we slow the economy too far? Two data points that impact that. From an unemployment standpoint, we are on target. So the unemployment does not say we are there. Hiring does. So hiring has slowed way down. So that is something to watch to find out if we're going to trend in the wrong direction here. Okay, what you're seeing here is the yellow line is the 10-year Treasury, the blue line is the federal funds rate. You can see, obviously, as you'd expect, Fed funds is determined, 10-year Treasury is driven by markets, so that's behavior that you see creating much more volatility in the 10-year. Interestingly, when these cross over, that's an inverted yield curve. Everybody know what that means? So that's when short-term bonds are paying more than longer-term bonds. We've seen a flat to inverted curve for quite a while, which is another reason why the Fed wants to reduce interest rates, is because inverted curves aren't healthy. They're not normal. In fact, a regular curve they call the normal curve, so they want it to get back to that. And many of you have heard that inverted curves lead to recession. The data doesn't support that. In fact, I heard that an inverted curve has predicted 10 of the last 5 recessions. That's good. You guys need me to say that again? Some of you got it. That was not, I didn't make that one up. I have to give credit to Mark Ochner from DFA who came up with that one. But so we see that data and what's going to happen here, right? They're trying to normalize the curve. You can also see that there isn't a correlation or it's not causative, right? The Fed funds rate, when we go back a couple years, has not changed until yesterday, but 10-year treasuries have still bounced all over the place. So that brings up kind of what happens when you move treasuries, right? We saw the market response on the stock side has been positive. We haven't seen the same thing on the bond side, but that's why we have to have patience. If you look here, what you're looking at is when interest rates are cut, right? 34% of the time, the 10-year goes the opposite way. Okay, so even though that was dropped, 10-year goes up. On the other side of that, 64% of the time when there's a cut, it goes down with it, right? Then you see the opposite when we're increasing rates. 65% of the time it goes up with it, 35% of the time it goes down even though the interest rate went up. So that begs the question, what does that mean from a market return? The average return and the daily return average month over month in the month following a cut is up 1.3%. When it's neutral, it's up 1%. When it's increased, it's up 0.9%. So again, you can kind of see this very consistent move that even though right after we don't know if it's going to go up or down, the market return on a monthly basis has still been very consistent. I showed this last meeting, and it's a kind of an obnoxious chart, but it just kind of tells you one of the things we're looking for in terms of equity exposure and how we treat the markets. What you're looking there is, this is the earnings yield. The blue is what stocks are paying. The gray, darker gray is what 10 years are paying. The 10-year treasury is paying. And this in here is what the spread is. Why that's important is because one of the ideas coming into this kind of interest rate change was that as bonds increase in return, stocks become less attractive. That causes money flows to flow out of stocks into bonds, and that could have a negative impact on the market. I showed in my first quarter session that the returns from peak to peak, so from the point interest rates hit the top, and you might be kind of seduced into saying, well, now I should shift money out of equities into bonds, and I should take advantage of that. The return in the market had been quite strong over those periods, so you still would have given up return. Now the opposite is obviously happening. If interest rates start to go down, there's a potential that we could see flows into stocks as the returns become less attractive. From a values perspective, it's hard because, it's hard to feel, and we heard this in 2008, lowering interest rate bails out debtors and it punishes savers. Which all of you in this room are savers. Maybe some of you are still a little bit of a debtor. But businesses, it's a little different, right? Because it's not the same. Debt is oftentimes growth. So one of the things that you've seen and you would have seen us do is we've increased allocations recently to small companies because small companies tend to be exposed more to interest rate changes. Reductions in interest rates, dropping capital costs, hopefully will kind of help small return to the mean, because small as a class this year has underperformed large. Those are some of, just as an example of why it doesn't mean do nothing. It just means that we're not getting in and out of things. We're just shifting allocations based on how these things have manifested from a historical standpoint. Okay? This is another one I brought back, and this is recession. I did a lot of work in the first quarter on recessions. You guys saw some of the stuff about recessions, how bad they are at predicting them and how late they are. And, they call a recession and the bottom was, 6 months after they called the recession. And I think you guys know that the recession is not determined by negative quarters in GDP. It can't be, by virtue of the fact that 2020 was considered a recession and it was only one quarter of negative. Right? It's determined by economists, and that's a whole different story. But what this shows is we still do have this lingering concern of, did the Fed get it right? We've been hearing a long time about the soft landing. Are we going to have a soft landing? And we really don't know. But what we do know is the concern or the risks that's still present are, did the Fed wait too long and slow economic growth too much, and is that ultimately going to push us into a recession? Nobody knows the answer to that, but it's just good to know that a recession does not mean, and I've said this before, but a recession does not mean you have a negative market. 5 out of the last 11 recessions have had positive markets. When you look at returns exceeding 2 years after a recession, you can see we get back to approaching market averages on average of returns in the market following recessions. Okay? All right. So I'm trying to make sure these are about 45 minutes because I don't want mass exodus when I'm talking. That hurts my ego. I want to make sure that, you know, that's why I keep the room cold, because when people nod off, that also hurts my ego. I was in Tony Robbins' book years ago, and he had us out for an event that was a pretty small event. And I don't know, have any of you guys ever done a Tony Robbins event? It's like 30 degrees in the room because he doesn't want anybody to fall asleep. So I've adopted that for you all, to try to keep you cold enough that you can't fall asleep. So I think, you know, getting back to some of those, even with that said, I'm still not keeping everybody in the room. You know, again, I want to reiterate, and, you know, I was kind of saving that, Ava, you brought it up early, so I had to go to it. But again, it's just the concept that we're not saying it's not relevant, right? We're just saying it doesn't indicate how to be a better investor. And there are plenty of things that do indicate how to be a better investor. They're just not the things the media talks about. I mean, we talk about small company premiums and profitability premiums and value premiums and momentum and trading, you know, on bands. Those have all been proven to create better investment experience. You just don't have media that, you know, that's not going to get you to tune in, right? So they're just not going to talk about that. So I want to make sure that when we have these conversations and we kind of have somebody leave and say, oh, again, they're telling me that stuff doesn't matter. It's just these things aren't what matters, unless you saw some patterns that we didn't. And I've talked to other people about kind of our philosophy being evidence-based investing. It's a really cool place to be because, you know, if the evidence changes, we'll change, which is such a great place to be. If you think about other fund managers that they stake their claim on, you know, value investing or whatever it might be, dividend investing or whatever, you know, what if the data changes? They have to admit they've been wrong the whole time. And I don't like to admit that I'm wrong, so I figure if I follow data, I can just let the data be wrong and not me, right? So, you know, we will continue to incorporate these things. They are incorporated into prices. The other thing I guess I feel like I want to say is it's cool that you can see the opposite thought processes and how they may not manifest, right? Most people that come into my office feel like the lack of ability to talk about the political situation is pretty, you know, toxic. The fact that we can't have a discussion, that we can't honor somebody else having a different opinion. You know, hopefully this data maybe creates a little empathy for people where you say, hey, you know, I still believe strongly. I'm not trying to tell you to go believe different, right? Don't go ripping any bumper stickers off of your car when you walk out of here, right? You can keep those on. But I think it is neat to see that that paradigm shift in some of the information and kind of have a standard of, is there really data that manifests it? Because for me, I only feel like I'm an expert in one thing. And, you know, I think we are now in a world where you know, Google makes everybody an expert in a lot of different things. So hopefully this is helpful from that perspective. A couple quick house cleaning items. Like I said, the next food for thought will be the video. I believe it's going to be at the Landmark Theater, and it's going to be we'll have popcorn and candy and stuff like that. We decided no booze because we didn't want everybody to be asleep. We figured if we put everybody in a room in the afternoon and fed you and gave you booze, then probably most people wouldn't make it through. But that will be coming up. Client appreciation event. You guys have seen the invitation for that. That'll be a fun time. I don't speak at that other than, you know, maybe a few thank yous. So that's always fun, and hope everybody who's around can do that. I do apologize if that conflicted with a religious holiday for anybody. We just did not, we went back and forth so many times, and we finally found something that worked, and we'll do better next time as far as that goes. Oh, client agreement. I just want to say one last thing. We've had some questions on the client agreement. You guys all got an amendment to the client agreement. I just want you to know that periodically the SEC or our securities attorneys require us to change language within the client agreements. That does not mean your services or your costs change. It's a frustration for us, of course. We don't want to change things. We used to have a client agreement that said every time we amend anything, you have to sign something. And so every time the SEC came out and did something or changed the rule, we had to send you a new agreement that had to be signed. Our new agreement says that as long as there's nothing negative to you, you don't have to sign it. So those are just disclosures, they're changes. The one about the referrals effectively said that the SEC says that if throughout the year we reward you with more than $1,000 of gifts, you're an employee. So you have to sign the solicitor's agreement. Okay, so we'll be very careful not to go above that. I apologize. Some people read that as, hey, they give us $1,000 every time we refer somebody. So I just wanted to make sure you know there's no action needed. There's no change in cost. If we ever were going to change something like that, and I don't anticipate we will, we would not just send you an email. We would do it more ethically than that. Again, I don't anticipate that, but just know that's who we are. Yes, sir.
In the slides that you had with the different presidents, you didn't have a column of unemployment rates and you didn't have a column of inflation rate.
Not in all of them, but the only one where that data was present was in the one that I compared Bush and Obama.
Isn't that important to know?
I think it's very important to know. It doesn't tell you anything about how to invest, but it's probably important for other reasons. You know who I was going to ask who they voted for in 1928? I'm just kidding.
My last question is, you don't have to answer it. Who are you voting for?
Yeah, I'm definitely not answering that one. All right, that's perfect. Thank you guys for being with us and enjoy the rest of your day.